Hello, I'm Curtis Chambers, Certified Financial Planner with the Chambers Financial Group. Fall is here, and it is the most wonderful time of the year. The weather is beautiful. Autumn is great in Florida after the long, hot summer season. But it turns out that it's not just the earth that has its seasons. The markets have pronounced seasonal patterns as well. Let's look at the S&P 500 and its seasonality and how that seasonality, what it may tell us about the fourth quarter of 2019 and the next 6 months. Fourth quarter has been historically strong for stocks, as this chart shows. The average S&P 500 index change since 1950, with the percentage shown on the left-hand column. And as you can see, the strong clustering of returns that occurs in the last quarter of the year in October, November, and December. Here we see the average S&P 500 index gains as a percent since 1950, cumulative per 6-month period. The November-April period, the period we happen to be in now, is historically the strongest 6-month period of the year, followed by October, March, and December, May. And then the fall off in the other 6-month periods. And this is interesting, what has given rise to the expression, sell in May and go away. And it's really sort of a joke, but it's a joke about the rather strong seasonality of the market, with the returns being clustered in these periods emanating from the fourth quarter. It's interesting that experts aren't really sure why these patterns of seasonality exist. One prominent theory is that third quarter corporate earnings come in during the fourth quarter, and that these earnings give investors visibility on what the new year may look like. And since most years the market is in a growth mode and not a recession, in most cases this looks good and investors bid up the shares in anticipation of the new year. I'm not sure if I understand this theory, because every quarter we get the previous quarter's earnings in, and we don't see this effect in the other quarters of the year. I want to emphasize, I don't see the seasonal patterns of the market as an opportunity for market timing. I believe the market will resist being timed. A good example is last year, in 2018, during the fourth quarter of the year, the market was down 20%. This would have been a disappointment to anyone trying to time the market based on the traditional or statistical seasonal strength for the fourth quarter. Perhaps the best explanation for the seasonality in the S&P 500 is that, like people, the markets are in a good mood in the fall, and like people, anticipate the opportunities and growth that a new year may bring. If you've got questions on the seasonality and how it may affect your portfolio, visit us online or schedule an appointment at our Largo office. We're not in it for the short term, not even until May. We're in it for the country mile.